According to Chainalysis, 96% of crypto traders are retail investors. Just 4% of crypto traders are professional investors, but these individuals and institutions account for up to 85% of all crypto market activity on any given day. As exposure to cryptocurrency becomes more common amongst legacy investors, their share of this pie will continue to grow, and so too will their influence on the crypto market. This means that it's more important than ever to know what the big players are saying about crypto and how they're allocating their money into the market. One of these big players is Fidelity Investments, which manages over $11 trillion in assets for its 38 million clients. 90% of Fidelity's biggest clients are interested in direct exposure to crypto, and this might have to do with the facts and figures about crypto that Fidelity has put together. Today, I'm going to tell you all about Fidelity Investments, what it's been saying about crypto, and where it thinks the crypto market could go in the near and long term. Before we take the bulls out on parade, there's a disclaimer that needs to be relayed. I am not a financial advisor of any kind, so investment advice is not something I can provide. All I can do is help you learn, and you can use that knowledge to help you earn. If this is your first time seeing me on screen, my name is Guy and crypto is my scene. The Coin Bureau is the #1 destination for the highest quality crypto content, in my estimation. Coins, tokens, news, reviews, exchanges, market moves, tutorials, whatever suits your mood. If this is the sort of content that gets your blood flowing, subscribe to the channel and ping that notification bell to keep that pulse going. You'll notice I left a few timestamps in the video timeline beneath me. You can use these to skip ahead, but remember that watching the whole way through is free. So now that you know how I roll, let me tell you why Fidelity thinks Bitcoin is digital gold. Fidelity Investments Inc. is an American asset management company based in Boston, Massachusetts. Fidelity was founded way back in 1946, and since that time it has grown to become one of the world's largest asset management companies. Depending on the metrics you use, Fidelity is actually the largest asset management company in the world. Now, Fidelity was silent about cryptocurrency until the last crypto bull market in 2017, when some of its top brass, including CEO Abigail Johnson, began speaking at cryptocurrency events. In early 2018, Fidelity launched Fidelity Digital Assets, a subsidiary company which provides cryptocurrency education, custody, and trading for institutional and high-net-worth investors. Like its parent company, Fidelity Digital has grown exponentially over the last few years, recently announcing that it was looking to hire over 100 people to keep up with the institutional demand for crypto. Fidelity Digital also filed for a Bitcoin ETF back in March. Over the last year or so, Fidelity and Fidelity Digital have both been conducting surveys around their clients' attitudes towards crypto, as well as the general sentiment around crypto from institutional investors across the world. The results of these surveys have made the crypto headlines on many occasions, the most recent being a survey of 1,100 institutional investors around the world conducted by Fidelity in July. This survey found that half of all institutional investors have invested in crypto-related assets already, with 70% planning on investing in the near future and 90% saying they'll be investing in crypto-related assets by 2026. In tandem with these reports, both Fidelity and Fidelity Digital have been hosting online events about cryptocurrency. And most of these events have featured Jurian Timmer, Fidelity's Director of Global Macroeconomics, who recently hosted a webinar titled, quote, Understanding Bitcoin, which inspired me to make this video. Now, to be honest, I actually missed the webinar by accident, but luckily Jurian summarized the slides on Twitter and also explained many of them in another presentation in early August. Even so, there are a few that are still lacking context, but I'll leave the slides in the description for you to analyze yourself if you're interested. As far as I can tell, Jurian's interest in crypto arose after Plan B posted the now famous Bitcoin stock-to-flow model on Medium in March 2019. If you watch my video about Bitcoin's S2F model, you'll remember that it uses a ratio consisting of the current supply, stock, along with the newly issued supply, flow, to forecast BTC's future price. You've probably noticed that Plan B's Bitcoin S2F model hasn't been all that accurate as of late, and according to Jurian, this is because it fails to factor in the other side of the equation, demand. Specifically, Plan B's model fails to account for the exponential increase in demand for BTC over time. Jurian projects that Bitcoin will follow a similar adoption curve to other innovative technologies such as the Internet. Typically, the adoption of these technologies starts off slow before accelerating and then tapering off as nearly everyone adopts them. When put on a graph, it looks like the letter S. Now, that may not look like it here on this graph, but that's because the data is being shown on a logarithmic scale so that it can all fit neatly into one graph. To model Bitcoin's demand, Jurian uses the number of Bitcoin wallet addresses as a measurement of adoption and assumes this growth will follow a similar trend to that of mobile phone adoption. Then, Jurian examines the adoption rate of innovative technologies within various countries along with their average per capita GDP and population size. This makes it possible to provide a more realistic estimate of how much money could flow into BTC in the future, something which Plan B's model grossly overestimates when you get into the 2030s and 2040s. Finally, Jurian puts all this data together to create his own Bitcoin price model. As you can see here, this model predicts a $1 million BTC by about 2030, at which point it will start to flatten out. After breaking down his own Bitcoin model, Jurian examines the narrative of BTC being an inflation hedge. I'll quickly recap what an inflation hedge is and why it's important, as it'll be relevant later on. So, as we all know, governments around the world have been printing money for decades. As basic economics dictates, the more of something there is, the less valuable it becomes. In this case, that's the US dollar, British pound, euro, and other fiat currencies relative to other things in the economy. In practical terms, this means inflation. The price of everything goes up because the currency you use to purchase those things has lost value. This has been the consequence of money printing since the dawn of money printers. Over the last year and a half, governments around the world have been printing money like mad, and this, coupled with supply shocks, has caused predictably high levels of inflation across the board. As I explained in one of my weekly crypto reviews, governments don't literally print money. Instead, the central bank buys government bonds, aka government debt, and gives the government cash to spend. This is important because government bonds determine the interest rates in the economy. If demand for bonds is high, interest rates are low. If demand for bonds is low, interest rates are high. By buying billions of dollars of government bonds, central banks can give governments massive amounts of money while simultaneously keeping interest rates low. Now, the consequence of this so-called quantitative easing is that almost every single country in the world is massively in debt. So much so that interest rates must remain at, near, or below zero. In some countries, like Japan, the central bank has bought more than 50% of the government's debt, and the supply of yen has grown exponentially over the last half-century. The crazy thing is that Japan's economy has remained relatively stable despite all this money printing, and Jurian thinks that other countries, including the United States, are planning on following Japan's lead. What this means is that inflation will only continue, and this means people need to protect their purchasing power. They need an inflation hedge. Believe it or not, Jurian argues that neither Bitcoin nor gold are the best hedges against inflation. All they have done is maintain their purchasing power, which is arguably what they're designed to do. Historically speaking, equities, i.e. stocks, have massively outperformed inflation, and this is mainly because the gains from gold and BTC can't be compounded year over year the way dividends can. Now that said, Jurian highlights the fact that Bitcoin has the potential to offer much higher returns than any other safe haven assets. This is partly because of Jurian's theory, which posits that BTC is in the same place gold was in the 1970s, something which is nicely illustrated in this graph. During the 70s, gold went up by a whopping 20x, complete with 70% corrections along the way, not unlike Bitcoin and many of the other cryptocurrencies we see today. If you're wondering where we are right now, Jurrien's own technical analysis suggests we're on the brink of another massive breakout like the one we saw in mid-April this year. Jurrien's compressed Bitcoin demand plus S2F model also suggests that we will see a 100k BTC in early 2022, which is also when Benjamin Cowen and Bob Lucas are estimating. Now, if you don't know who these chaps are, I recommend watching my video about some of my favorite crypto YouTubers using the link up there in the top right. Anyways, the cool thing about Jurrien's Bitcoin model is that the assumed demand curve acts as the lower bound range for the BTC dip that comes after the top in early 2022. This seems to be between 30 and 50k. On that note, another bullish indicator Jurrien is looking at is the number of Bitcoin wallets holding more than $1 in BTC, which is fast approaching its previous high of 34.2 million. Jurrien is also a fan of the fact that the so-called Bitcoin tourists all got wrecked and left, and he even takes this as a sign that the dip down to 29k in July was the bottom for this bull market cycle. Meanwhile, the number of hodlers has only been increasing, with a record 12% of BTC's supply being held for more than 10 years. The only problem is that this figure doesn't seem to factor in all the BTC that's been lost over the years, which is something else I covered in a video that you can find in the description. And now for the big question. What does all this mean for altcoins? Although Jurrien has not done deep dives for altcoins yet, his analysis of Bitcoin gives us all the information we need to see these coins and tokens through the eyes of an institutional investor. If we take Jurrien's words as the gospel truth, institutions see the ideal cryptocurrency as having three features. 1. A lot of demand and user growth. 2. Robust tokenomics, meaning a maximum supply or a fee-burning mechanism which is strong enough to cause deflation. 3. The ability to generate some sort of cash flow, ideally a cash flow that can be compounded. Say, this sounds like a few proof-of-stake cryptocurrencies. Now, one of these is, of course, Ethereum. The number of Ethereum wallet addresses has been growing steadily, though it does look like it might be peaking. Ever since Ethereum's London upgrade went live, over 400,000 ETH has been burned, and its supply has already flipped into deflation mode once since early August. Although Ethereum has not yet transitioned to proof-of-stake, it's already possible to stake ETH and earn an interest rate of roughly 5.8% per year. If all goes smoothly, we could see Ethereum transition to proof-of-stake before the end of the year, and you can get my most recent Ethereum update up there in the top right. Now, another cryptocurrency that seems to meet the criteria of institutional investors is Cardano. There are currently over 2.3 million unique Cardano wallets, and though I can't find a historical graph of Cardano's wallet address growth, I think it's safe to assume that it's growing in anticipation of Cardano's smart contracts. ADA also has a maximum supply of 45 billion, and ADA staking rewards are currently around 4.6% per year. Oddly enough, the crypto that takes the cake in the institutional eye seems to be Avalanche. This is because Avalanche's user growth has been exponential. At the start of this year, there were just 3,000 unique Avalanche wallet addresses. Today, there are over 180,000. AVAX has a maximum supply of 720 million, and it also burns all transaction fees on its blockchain, which are, of course, paid in AVAX. To top it all off, AVAX staking rewards are just over 10% per year, which is not far off from the average annual yield of 11% on stocks. Now, if you want to learn more about Avalanche, you can find my most recent update about the project in the video description. So, to wrap things up, I want to touch on something insanely bullish for Bitcoin that Jurrien could see happen in the next few years. Earlier, I explained that whole thing about money printing and mentioned that Japan's central bank has been buying up most of the government's debt. Again, this has had the effect of suppressing the interest rates on government bonds and, by extension, the interest rates on debt in the entire economy. The thing is that it's not just central banks that buy bonds. Individuals, institutions, and even foreign governments will buy government bonds because they're viewed as a safe investment. Jurrien is a big proponent of the 60-40 rule, 60% in equities and 40% in safe haven assets, including bonds, gold, and now Bitcoin. This investment strategy is popular among many seasoned investors. So, riddle me this. What happens when bond yields are being kept constantly low or even negative because of central bank buying? Well, Jurian posits that at that point it makes sense to allocate some or even all that bond money into other safe haven assets in that 40% slice of the pie. To put things into perspective, the market cap of treasuries, aka short-term government debt, is a staggering $22 trillion in the United States alone, and that's just the short-term debt. If Jurian is correct about the Fed's plans to continue purchasing government debt far into the future, then at some point investors in the private sector will think, well, what's the point of me holding this when I could be holding something better like gold or Bitcoin? According to Jurian, quote, many investors have already done so, whether via inflation-protected treasuries, low-duration bank loans, or commodities such as gold, and the opportunity cost of such a shift has become less and less. If even just a fraction of those government trillions found their way into the crypto market, it would take everything to new all-time highs, and it's possible that this effect has already begun. Only time will tell whether this is true or not, and remember there will be a lot more volatility before we see all those big numbers everyone is dreaming about. After all, there are a lot of bullish and bearish events coming up this month, and if you've no idea what I'm talking about, you need to click that link up there in the top right ASAP. Now, I must say that looking into Fidelity's views on crypto has been a big eye-opener about how institutions view not just crypto, but the economy in general. As far as they're concerned, the money printing is just going to continue indefinitely, and that money will inevitably find its way into assets like stocks, gold, and Bitcoin. This means everything is just going to keep going up in price, and that means the only way you'll protect your purchasing power is by investing in something that will at least keep up with the real rate of inflation. So far, it seems like BTC has been doing that and then some. I reckon Jurian's Bitcoin model is fairly robust, and it's probably one of the best ones I've seen so far simply because it gives you some more realistic expectations in terms of price and the timeframes in which those prices are likely to occur. One of the only major issues with Jurian's model is that it fails to account for people who are holding crypto in a custodial manner with a cryptocurrency exchange or even a professional crypto custodian. These people will obviously not show up as new users on the Bitcoin blockchain, and this means Jurian's model might actually be underestimating just how big Bitcoin could get. The fact that Bitcoin is missing one of the most crucial elements that most institutional investors are looking for suggests to me that a flippening is on the cards. Yields are everything to legacy investors, and the institutional adoption of DeFi we've seen in recent months proves that. Once Ethereum 2.0 goes live and institutions feel more comfortable with other proof-of-stake cryptocurrencies, we could see a bull run unlike any other, especially if they ditch their government bonds for ETH, ADA, AVAX, and others. Alternatively, this could all cause people to lose confidence in the dollar, leading to a level of hyperinflation across the globe that crushes all assets. That's not a future I want to see, but regardless of what happens, I'll be hodling my BTC. If you're with me, go on a like button clicking spree. While you're at it, subscribe to the channel and ping that notification bell to make sure you stay in the loop. If you're desperate for more crypto content, check out the Coin Bureau Clips channel and follow me on my socials. I've got a Twitter, TikTok, Instagram, obviously the best Telegram, and even a weekly newsletter that comes jam-packed with the tools, tips, and tricks you need to conquer the crypto market. The only thing better is an official Coin Bureau tee or sweater. You can get yours using the link in the description, right under the links to all of my socials. And that is a wrap for today, my friends. Thank you so much for watching, and I'll see you all in a moon or two.